Okay, so now we're going to cover what Sam has recently built, which is a calculator to help you make a better informed decisions whether you want to invest in a real estate property or invest in the stock market.
Let's do it. So, I want to walk you through some of the inputs.
Please.
Assuming a current portfolio value of $500,000 and assuming a 100% equity portfolio, assuming we can drop this off. If you're a DIYer, we'll put this to zero for advisory fees. Real estate purchase, assuming a $700,000 purchase with a 20% down payment, closing costs of about 3%, and a mortgage interest rate of about 3.88%. The amortization period, 25 years. We could also do 30. Should we do 30 years? I think most people are taking 30-year mortgages now anyways. Let's do 30 years. Let's assume the annual gross rent is about $36,000 or $3,000 a month. That might be a little bit high. Let's assume there's a 5% vacancy rate, 5% operating expenses, and property appreciation of 2%, and that you increase rent every year by 2%. Now, let's assume that you don't put any more money into the property from like a renovation or initial capital expenditures, and you're not hiring a property manager. Let's assume that you hold this property for 30 years as well. Okay. Now, if you own this personally, right, we have to understand that there will be some taxes that will come into the equation. Right now, we're not accounting for the taxes on the personal side. If we were to look at holding real estate in a holding company, we would count for taxes in there. But what
you checked off use leverage here. Do you want to check that off or
no? They are using leverage for real estate. Yeah.
True. Okay. I just wanted to make sure it was right. Okay. And sorry, can you walk again through? So it's the $500,000. That's your current portfolio value. And then how much are you taking out of your portfolio to put on the real estate?
$161,000. That is the 20% plus closing costs.
Perfect.
Okay. So what we're looking at then is the value of the remaining portfolio plus the value of the property in 30 years plus the present value of invested cash flows, right? So the rental income. Okay. So all of that formulates into something called an internal rate of return. What we're projecting on the equity side, the portfolio side, is that you earn 7.31% gross return. Okay. And that's over that entire 30-year period. What I'm going to walk you through is what comes out if your investment does 7.31%. And then what the break-even point is on your portfolio that you would need to earn in order for your portfolio to outperform the real estate side. So, what I'm going to look at first is, well, I guess we can look at the net winner first here. So the net winner in this scenario is the real estate. And there's a few reasons for that. Number one is when we calculate the internal rate of return, I'm going to scroll down to here. The real estate internal rate of return, this is pre-taxes, is 9.14% versus the portfolio rate of return versus a portfolio rate of return of 7.31%, right? So what we can see is that the real estate wins on that aspect.
Makes sense.
Yeah, so that kind of makes sense, right? So when we're just purely looking at it from a pre-tax perspective, real estate wins. If we look at cash flows on a property like this, let me just see here. The annual free cash flow. So basically when we look at the mortgage costs, where are we here? When we look at the monthly payments, so annual payments are $31,500, or monthly payments on the mortgage are $2,625. And then when we add in other costs like potential vacancy rates, operating expenses, and things like that, what that means is in year one, if we scroll back down here, your actual net free cash flow will be about $900, and that will increase over time as your rental income increases due to just the 2% increase that you're charging in rental income, right? So if you're charging your rent, increasing that 2% every year, this will start to increase over time. Now, in this scenario, one thing that we're not really accounting for is something called risk premiums. We're not accounting for this yet. And risk premiums, what they do is they look at the option of should you of basically the risk, the return demanded for the risk that you're taking. So, for example, in a 100% liquid total stock market index fund portfolio, you've got complete liquidity at any time that you can withdraw, right? So you don't have that in real estate. So in order for you to lock your money away, you should be getting some sort of excess rate of return for that. Does that make sense? Like you should be getting a premium for locking your money away. Because if I told you you have option A, option B in a portfolio decision, option A and option B give you the same rate of return over a 10-year period, but option B locks your money in for the 10 years and option A doesn't, which one would you choose? Well, obviously option A,
Option A,
right?
for sure.
Right, because you don't want
This
your
is
money
this is
locked away.
key
That's
to
a risk.
understand. And we
Yeah.
wrote that in the video as well. Like in my example, where if someone have all their money tied into a home and now they need to retire, you can't take out your door to go pay for your grocery bill. So you
Exactly.
need to sell, right? You need to sell the home to liquidate, to bring up your liquidity profile as an investor. And that's what we're talking about here. The liquid portfolio, you can sell overnight. The next 2 days after, it's, maybe 3 days after, it's in your bank account. And then, but you can't do that with a physical asset. And that's what Sam is referring to. So you need to factor that in order to make more of an apple to apple comparison.
So I think it's fair to label the risk premium of liquidity at 2%, right? And we go back and forth on that. But when I've looked at the data on like what the liquidity risk premium is, typically it ranges from 2 to 3% that people demand as extra compensation for taking that risk of locking their money into a fixed asset. When we do that and we subtract the risk premium off of the internal rate of return, what we get is the risk adjusted rate of return, right? The risk adjusted internal rate of return drops to 7.14% versus the portfolio of 7.31%. So now, accounting for leverage, accounting for everything, you're looking at you're looking at a situation where after 30 years, you'd still have more potential money with the real estate, but you would not have been compensated properly for the risk that you're taking for that. So it's not, and one of the worst things you can do as an investor is take uncompensated risk, right? So what would need to happen in order for, on a risk adjusted basis, the real estate to make more sense? Well, you would need to see a higher property appreciation. So if we jump up to 3%, right, all of a sudden, your now risk adjusted internal rate of return goes to 7.9. Okay.
Which is not far-fetched. I mean, I think the growth is closer to 4% historically, maybe in the last like 20 to 30 years. So, two, maybe we are undershooting it, right? So as you're increasing that rate of return, of course, with the leverage, then you're juicing up your return. And then even on an risk adjusted basis, so once you factored in that illiquidity risk that you're taking, then that's why you're getting much, much further ahead. And if you happen to be in a market where it was like maybe massively undervalued, and then you're seeing huge price growth, and maybe you're closer to, let's say, 5 or 6 or 7%, then that spread is even more enhanced, right? Which
Yeah.
makes sense.
And then if we look at the break even points where your portfolio would equal the same amount of net wealth at the end, you're looking at your portfolio needing to earn 9.9%. But this is a key distinction here. The reason this is the case, you might think, well, wait a second, like my portfolio is making 9, but my property is only earning me 3% plus cash flows. Like, how does the math work here? And basically what we're utilizing here is leverage. And what you're seeing here is something called return on equity. Return on equity is essentially the dollar return for the amount of equity you have in a property. So if I have an option to purchase a $1 million asset, and that $1 million asset is going to give me a 6% return, that means that $60,000 in real dollars I'm going to be earning. But what if I only have to put up $100,000 of my own money to buy that $1 million asset? Well, now I'm getting $60,000 of returns on a $100,000 capital investment. My return on equity is crazy. It's 60%. Well, it would be 60% pre interest costs. So what we can see here is that with leverage in the mix, because you're not putting $700,000 down to buy a $700,000 property, what you're doing is you are looking at a very high return on equity in the first year. And as you pay down the principal, meaning you've put more dollars now towards the purchase price, you're now going to get lower returns over the lifetime of the property the more you pay down the principal. So if we wanted to make this an apples to apples comparison, what we should actually judge investing in property versus investing in investing in stocks, what we should do is we should illustrate a situation where you have a $700,000 property and you have a 100% down payment on a $700,000. So you've got $700,000 portfolio, and we're illustrating a $700,000 down payment on a $700,000 property. So you're buying it in cash.
Like a non-levered, but then your returns are going to be
then your returns go
Horrible.
down, right? So
I know.
if we look at this now, and let's even say property appreciation jumps up to 4% a year, right? 4% plus the cash flows you're getting on that $36,000 of rent, and people are always in a rush to pay off their homes, and that's not a bad thing. But like when we look at let's see here, even when we take out risk adjusted returns, what we're going to see is it's very, very close. The real estate gives you 7.59% versus the portfolio 7.31%. When we add in the risk adjusted, the risk premiums, let's just account for liquidity risk, the portfolio crushes it versus a
Yeah.
stay and do nothing and just stay invested versus buy real estate on leverage. And that's at 4% growth rates, 2% rental increases over time, right? On a 30-year holding period. What I'm not accounting for here either, guys, is the post-tax amount of rental income you'll actually be able to claim. Right. And so if we were to do that, let's say you're at a 43% marginal tax rate, let's say, your real actual after tax income on this is about 50% after you deduct for interest costs and those types of things. So if your real after tax annual gross rent is, let's even say it's $25,000, which is low, right? Then we're looking at it being much worse to invest in real estate when we factor in taxes. Even when we take away the risk premiums, you're still looking at a total of 1% lower.
But you also I think you're also missing the interest cost that can be deductible.
Yeah,
Which is
so
not
that's why
factored
I
in
did
as well.
lower it by 50%, right? We can actually
That's what it's okay. That would be
Yeah.
factored in. Is that what? Okay.
Yeah. So basically, let's look at taxable income of 36,000. The interest cost, if we have this here, we don't have this on the personal side. We do have it calculated on the corporate side.
But no, I
Well, I
think
guess
that
no. In this scenario, there would be no interest deductions
no,
because it's not
that
leveraged.
yeah, that's what I see. But if you were using leverage, then that's also yeah, that's also like a key factor, right? And hence why I think the takeaway from what Sam just shared here is the more leverage, the more borrowing you have in your property. That's why the Smith maneuver is so popular. And just at a high level, the Smith maneuver concept is, um, it's this concept where you re-advance the principal that you're paying and then you invest it. The point is that you keep your leverage level the same throughout the entire period, so you're not paying down your principal. And that's what Sam alluded to. The more principal you're paying, the less return you're actually going to get. And then when you adjust everything on a risk adjusted basis with the illiquidity premium that you need to factor in, that's where the real estate is usually underperforming your portfolio. And then depending on but again, that will depend on a lot of factors, which is all covered in. But I think the takeaway is that it's a fascinating tool and it's just another way to help you make a more objective decision before
Mhm.
you commit maybe tens of thousands, hundreds of thousands of dollars into an investment property. You're paying the closing cost, the realtor cost, anything, because your transaction cost in real estate is extremely high, right? If you look at a 5%, for example, versus like the investment world is, now you're looking at like pennies, but that's another thing to factor in, like getting in, getting out. Those are like big decisions. And then you're at the mercy of like where prices are at. You can always sell. You might not sell at the price that you want. That's
Yeah.
the other thing too. So if you're not gonna want to get a huge haircut on an investment property you bought, that's a tool you can use to try to factor in different scenarios here to help you make a better decisions to see, does it make sense to pull money out of my portfolio to buy this? Yes or no? And so on. Again, that's just the financial side of things. There's also the other things that you actually enjoy dealing with landlords. Let's say if you don't have a property manager, right? Some people really love that. They don't mind it. They love to go see it. I own this, I own that. If that's really important for you, this is harder to quantify, right? Versus your investment portfolio, you can't really flex. You don't show your statements to your friends, right? When you walk around, but you can tell your friends like, oh, I own like 5 condos here, right? So
Yeah,
it's just a different game. It just
it is.
depends what matters to you and what you want to do and then how you want to go about your wealth and what makes you happy. That's any last closing thoughts here that you want to leave the listeners with?
If you want to have an analysis done, just reach out. We can do this analysis on your portfolio as well and versus investing, and happy to do that. But yeah, I think it was a very of a substantially full episode of good information here for people to take into account of their current situation. So I'm happy we did this.
Yeah, great chat. I hope you guys found it insightful, and With that being said, we'll see you in the next episode. Enjoy the rest of your week.